Welcome back. Earlier today, the Shiller Home Price Index was reported. The home price index on a monthly basis up 0.43%, year over year 2.6%. The 20 home price index month over month 0.35, year over year 2.2% increase. The all transaction house price index flat on the monthly basis up 2.7%. Now, by most accounts, today's number was a good number, but what we're going to see is the progress is slowing down. The all transaction house price index actually is flat for the fifth consecutive month. The standard home price index that's most widely reported, that's increasing. It's maybe the fifth consecutive increase. Uh, However, the increase, as we're going to see in just a few moments, it's coming after a significant sell-off. And then the 20 city home price index, which measures specifically the 20 largest metropolitan areas, that also marks a fifth or sixth monthly increase. However, what we'll see in just a moment, it's very, very far away from where we want to be. Here we see the red line's a home price index on a year over year basis. The blue line's a 20 city home price index. And then we have the all transaction house price index. They obviously all move very, very closely together. After a precipitous fall from the to the downside from highs that we saw late 22, early 23, we are trending back to the upside. But again, this is a big drop to the downside. We have a lot of room to make up. The blue line in this case is the 1 year US Treasury note. The 10-year is green. And among the most interesting facts here is the fact that we had the beginning of the inverted bond market. We've spoken about this quite a bit. June of last year marked a real significant turn to the downside. If you kind of match up these lines, you can see the home price index was almost at its all-time high, and then moving to the downside just as the inverted bond market came to be. And this is updated as of August in terms of the bond prices, but nevertheless, we have a very significant inverted bond market that is persisting. And with that in mind, if history is any judge, as long as we have an inverted bond market, it shows us that there's strife within the bond market, the fixed income market, and that usually does not bode well for the home price index. Here we see the S&P 500. Again, this is adjusted to match the August report that we're speaking of today. The red line is a home price index on a year over year basis. Typically, we have a positive correlation, except for the humongous sell off we saw in the home price index while stocks trended higher. Well, recently, we know stocks have been rather on the weak side. Maybe this is a return to normalcy, a regression to the mean, where now we see home price index. Well, it's starting to trend a little bit higher, but after coming down quite a bit, maybe the same holds true for the stock market. Here we see federal funds rate. It's very clear that low interest rate environments are usually good for the home price index. Conversely, the high interest rates that we see now, again, we have an improvement. This is again the fifth month over month basis, but the improvements are slowing down. And logically, given the very high interest rate environment, it's difficult to see how this upward trend will continue. At least that's what the data suggests. Now, actually taking a look at the numbers, this is where we are right now. This is a US Shiller Home Price Index year over year basis, 2.6% year over year improvement. The 20 city home price index up 2.2%. Notice where we were though. 2021, 18% to the upside. That's a year over year basis. Now, of course, that's not exactly fair because 21 year over year was comparing those numbers to what was happening in the midst of the COVID crisis in 2020. So discount those numbers to some extent. But even going back to the beginning of the inverted bond market, June of 22, 18% year over year, 18.7 on the 20 home price index. Well, that quickly fell, and now we're at just above positive level, 2.6 and 2.2. Well, go back to 2008, 2007. Look where we were if we wanted to match up these levels. We'd see October of 2006, 3% year over year, and that was also the case for the 20 city home price index. Then we had November's number, that was 2.2 and 1.8. And then within the next few months, the numbers went negative until we know obviously what happened with the housing market in 2008. Now, it's not to say that history will repeat itself exactly. We certainly could bounce, but it's interesting to see that if we match up the numbers, we're at what, 2.2, 2.6%. That matches up with where we were October, November of 2006. And again, this is where we are right now, 2.6 and 2.2. Again, history does not necessarily have to repeat itself, but then again, if with history as any judge, with a high interest rate environment, these numbers certainly look very, very similar. We have a very big economic calendar, Federal Reserve meeting coming up, so we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.